Hi, I'm Brian from Zenith Investment Partners. I'm here to talk about global small caps and more specifically the Pengana Global Small Companies Fund. Investors have long been comfortable with small caps in their portfolios from an Australian equities context. However, this hasn't been the case from a global equities perspective. At Zenith, we believe global small companies exposure has the potential to enhance investors' investment outcomes. Similarly to Australian small caps, global small caps are an inefficient segment of the market with little or no analyst coverage and low institutional ownership. Given this inefficiency, performance of global smaller companies has outpaced their large cap counterparts historically. Over the past 10 years, global small caps have outperformed large caps by 3% a year. While the return profile is attractive, it comes with added levels of volatility. As such, we believe an exposure to global smaller companies is appropriate for investors with an investment timeframe of at least 7 years. Today, I'm talking with John Moog, the portfolio manager of the Pengana Global Small Companies Fund. The fund is managed by Chicago-based Pengana subsidiary Lizard Investors, and it provides exposure to a value-biased global smaller companies. Zenith has assigned a recommended rating on the fund, and it has been in place since 2018. So, John, can you tell us a bit about your background and investment philosophy and the objectives of the fund?
Yeah, great, Juan. Thank you for the introduction. And for those of you who don't know me, my name is John Moog. I'm the CIO and portfolio manager of Lizard and the Pengana Global Small Companies Fund. Lizard has been around since 2008. We launched our first fund in January 2009. Both myself and David Lee have been with the firm since inception. And we are focused on global international small cap investing. And I've been investing in equities for over 20 years. Philosophically, we aim to put together a portfolio of very high quality businesses that are under the typical institutional radar screen and then allow those businesses to compound value for our investors. It also allows us to protect downside in the best ways we see possible in the small cap space, where we think quality business is really the most critical feature in protecting capital. The 5 factors we use to think about how high quality businesses really are a business's ability to generate high returns on capital over a long period of time, really centered around their competitive advantages. The second thing we think about is balance sheet strength. The third thing we think about is management alignment. And the fourth thing we think about is corporate governance. And then valuation is obviously critical for us in terms of what gets into the portfolio. But we think by building a portfolio of diverse businesses with these characteristics, it allows us to really create a fund that will perform through many different market cycles. And we hunt under the typical institutional radar to find these businesses at very attractive prices.
Great, thanks, John. And so there's a lot happening in the market. And so why do you think it's a good time to invest in your fund right now?
You know, I think that's a good question. Right now, I think the market, it's been a really fascinating market. It's gone through a really significant market cycle in the last 18 months. I joke that we've been through a 5-year market cycle in the last year and a half. But right now, I think the market's extremely bifurcated. It feels a lot like the late 90s and early 2000s to us, where there are pockets of the market that have become extraordinarily expensive. There have been significant capital flows chasing very few number of equities, and you really see pretty significant distortions in equity valuations. Underneath that, though, we think there's a very significant opportunity within those businesses that are being ignored by the market, frankly. And so much like you saw in 2001 to 2003, as long as you're really able to avoid some of the pitfalls of the more expensive end of the market, despite the NASDAQ and a lot of U.S. tech stocks selling off really dramatically in that 01 to 03 period, the rest of the market performed really quite well throughout that period. And we think the same thing is true today. We see non-U.S. equities trading at a 20-25% discount to their U.S. peers. And we think what we are finding is a very interesting opportunity to find high-quality business, again, under institutional radar screens, trading at really attractive valuations that we think will compound returns at a nice rate over the next 3 to 5 years. And we think it makes it a compelling time to look at our fund because we've been able to build a portfolio full of these things. Our fund is positioned heavily towards non-U.S. We're significantly underweight non-U.S. or overweight non-U.S. relative to the benchmark. And given some of the things I was just talking about, we think that is a compelling position to be. again, I talk about those very exciting valuations, but also on top of that, we're starting to see some, from a timing perspective, we're starting to see some really interesting things percolate, and some catalysts forming around why this positioning may be really good, a good time to take a look at this positioning of the fund. And we're seeing economic growth start to accelerate in Europe and in other areas around the world at the time where you see deceleration in U.S. economic growth. That has a lot to do with vaccine rates now in Europe surpassing those in the U.S. The rest of the world is beginning to catch up and open back up and return to life as normal. And many economists expect a pretty big jump in consumer spending in a lot of these regions. And so we really expect that to propel a lot of non-U.S. companies' earnings. Conversely, you're starting to really feel a lot of inflationary pressures here in the U.S. Shipping concerns and higher taxes are starting to really weigh on growth in the U.S. market. And so we feel like it's a really interesting time to take a look at our fund because we have this unique positioning of small cap non-U.S. That's a bit overweight in the fund. And so, I think to summarize, ultimately we feel the fund is really well positioned with a collection of excellent companies that are compounding value and that have significant economic tailwinds starting to form. And we think that should benefit the portfolio over the coming 3 to 5 years.
Yeah, well, thanks, John. And I know that you guys focus on downside and capital preservation as well. And so, what happens if the inflation environment doesn't play out the way that you expect? And I guess in what environments do you think the fund won't do as well?
Yeah, I think that's a good question. And I think given the position of the fund, we have been underweight for U.S. for a period of time. And I think really many of the headwinds we would have expected have existed since the fund launched in April 2015. We've had a very strong U.S. economy, very strong U.S. stock market, and a strong U.S. dollar. All those things, given our positioning, should tend to be a bit of a headwind. But despite that, the fund has performed quite well, both on an absolute and a relative basis over since inception over the last 5 or 6 years. And so despite, even if these tailwinds or catalysts that I'm talking about don't form, we really believe that our focus on high quality businesses will outperform really almost any market cycle. And I think we have evidence of that now since the fund's been open since April 2015.
Great. So maybe you can bring the process to light a little bit, and maybe you can give us a couple of examples of stocks that would meet your investment criteria and your high conviction.
Great, yeah. So absolutely, happy to do that, Juan. The first company I'd like to chat with you guys about is SoftChoice. SoftChoice is a leading Canadian software-focused IT service provider. That's a pretty fancy way of just saying they sell software and IT services to many small and medium-sized businesses, mostly in Canada, but also in U.S. as well. But they have a large leading position in the Canadian market. This is a business we acquired at the IPO. We felt that this business was quite undervalued because it did list in Canada and there are really no comparables in the market. But ultimately, we find what we really like about this business is a well-run company that grows nicely, both organically based on market share gains as well as increase in spend in IT. And we really took advantage of what we think is a lack of awareness in the industry in Canada at the time of the IPO. And we've seen management really improve the quality of the business over the last 5 years when it was under private equity ownership. They've invested heavily in their cloud offering, and we think they're well positioned to capture value going forward.
Right. And so what makes this business high quality in your mind, and what gave you the ability to judge that?
That's a good question. Thank you. So, what we often find in some of these businesses is that these industries develop at different times in different places, and this IT service industry and sales industry is one that we've really seen develop in the U.S. and in the U.K. over the last 10 years. And what we have found is that as customer needs have gotten more complex in this industry, you have been forced, if you're a seller, to vertically integrate, so become an expert at cloud, security, mobile, and really offer complex solutions to smaller customers. So the complexity in which these organizations have to operate in has gone up pretty dramatically. And this industry used to be quite fragmented over the last 20 years. But what you have found is that given the increasing complexity, those large players are the only ones who've really been able to make an investment in their underlying infrastructure to support their customers. And so we think Canada is really going through this transition now. We've made prior successful investments in Softcat and Bytes in the UK, and that really gave us an understanding of how big the competitive advantages were becoming in this industry. So from our perspective, we really think the complexity around the solution set and the fact that we're investing in the largest scale player in the market becomes really important in terms of driving organic growth going forward and really creating those sticky customer relationships that create a significant competitive advantage.
Sounds like a very very exciting opportunity, John. So is there another example that you can provide as well that might contrast with that investment you just spoken about?
Absolutely. Another example in a totally different industry, in a totally different place in the world, is Countryside. Countryside Builders. Countryside is a UK-based home builder that focuses on community redevelopment for local governments. And so what they have taken on are large-scale projects, redeveloping entire communities, partnering with local governments. Local governments fund a significant amount of the development in these projects. And Countryside is really the only player in the market that operates this business at scale versus other home builders who really are building one-off homes. And I think one of the things that really we love about this company is they are really kind of in a dominant position in this segment of the market. But this segment of the market is also going to grow really dramatically over the next 5 to 10 years. The UK is chronically underhoused, so to speak. There's a housing shortage. And this is really one of the key solutions that will enable the UK to meet the housing requirements of their growing population. So what we really like about this business is it's a growing business in an industry where they have a clear competitive advantage. There's relatively limited working capital requirements, especially when you compare it to traditional home building. So the business generates excellent returns, has high visibility into growth, and has a leading market position in the markets they operate in.
Yeah. Okay. And why did this opportunity exist, and why is the market only recognizing this now?
So I think that's an interesting question. And oftentimes what we see in small caps are changes in capital allocation that aren't fully appreciated by the market at the time we make the investment. And so this company actually used to have, and still does have, two divisions. One is this public housing project division I talked about. The other is a more traditional home builder. And so management has announced with some pressure to the board, management's announced that they are going to put their traditional home builder into runoff. And so what that means is the low return business is going to go away while they're going to focus all their capital on the high return business. This is something that we think is a really critical change in the business and going to be really beneficial. And I think from our perspective, what we love about the space we operate in the small cap space is oftentimes it takes the market a while to fully appreciate these changes, but that really creates the opportunity for us to get invested before there's a meaningful change in the stock price and take advantage of what is a really high quality business.
Well, yeah, thanks, John, for showcasing your investment process with a couple of pretty interesting stocks there. So from our perspective, just to summarise, the global small cap space for us has really taken off in the last few years. And but one thing that I'd like to highlight is that Pengana Lizard guys have been around and we've been rating them since 2015 in the Australian market. Another key point that we really like about the fund is that it's a value style investment. So in a growth asset class, being global small caps, you're going to get a very different shaded profile. And you can see with the position with overweight non-US, and that's quite a stark difference to the peer group. And the other thing is that the team's been around for a while, and that gives us a lot of conviction in the repeatability of the process as well. But at this point, I will turn it over to John for any closing remarks.
So I think I'd just like to finish by saying, I think we continue to be excited about being able to invest in what we think is a really compelling market niche full of interesting opportunities that generates really very good risk-adjusted returns over time. I think when you combine that with the fact that economic factors and valuations are quite compelling for our strategy, we think it's an excellent time to take a look at our fund, and we're pretty excited about the future. And I'd just like to say thank you very much, Quan, for the questions and allowing me to share our story, and thank you to everyone for listening.
Thank you.